welcome everybody. Today is Thursday. Today we got a very special show, a new thing for our regulars, a new thing for all the new folks that show up when Paul Shively, the Pied Piper of real estate knowledge, brings his minions and brings his amazing fortune builders community to the show. The subject we're talking about today is cash versus debt. Why is it that the rich, when they have all the cash in the world, they're able to just buy these houses straight up, they still choose debt? It's not that they don't choose cash, is that why would they sometimes, and quite frankly, often choose debt? We're going to break that down for you. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because of his genius concepts, because he generates cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And our resident expert, the man that we affectionately like to call the Jason Statham of real estate investing, the man who has been a part of billions of dollars in real estate transactions. He is the head of the Passive Income Club. He is today showing off his amazing muscles. His name, Paul Shively. Welcome back to the show, Paul Shively.
It's great to have you, even though you make me slightly uncomfortable when you talk about my muscles, but that's okay. I appreciate it.
I'm just, this thing is really, you had you got like the grapefruit in there. It's really nice, man. You can tell.
I appreciate it. Thank you. It's great to be back. Still waiting on my 7-timers jacket, 8-timers jacket. Now
There's
I'm just gonna keep saying it every show until it happens.
There's not gonna be a number on the jacket, but we talked about the jacket this morning.
We did.
I'm sure you have.
We're more cardio guys than back and buys guys, but we were doing exercise this morning as well, and we talked about your jacket. Just so you know.
Good for you. Good for you. I'm a 42 regular, just in case you need to
That's what we were asking.
Duly noted.
Yeah, I was like, do I need to go back 42 regular? Thank you.
Got
Put that down. All right, what folks?
Very average. I'm very average. Not your average show, but I'm an average size.
Average size, but compact with dense muscle fiber. That's all right. Anyways, let's get into the real estate. Let's get into the real estate education, everybody. Before we do, just gotta say, we are exactly 1 week out from the Not Your Average Investor Summit.
Oh, yeah.
We're super excited. February 16th, 17th, we've got over 125 people here showing up. GC's got a little update on it.
Yeah, so excited. So just a little bit of housekeeping. I know you all have been asking about great questions like parking. Hopefully by now you have your hotel stays, but if you need any information there, check your emails. They have been sent out to you. Day of agenda information sent out over email. So if you are one of the guests who's able to come to the summit, those emails have been sent out to you. There is a WhatsApp group that I would highly encourage all of you to be a part of. We have over half of the attendees for the summit on the WhatsApp group, and people are talking about what are they doing the night before? Where are they staying? How can we meet up? All that good stuff. So highly encourage you to get on the WhatsApp group. Again, you can get that information on the emails that have been sent out to you. And then lastly here, we've been getting some requests from all of our attendees that are coming in, asking if we can do individual property tours on Thursday or some other days around the summit. And the reality, guys, is that we've got over 125 folks that are coming in. Unrealistic for us to be able to do those individual property tours. But don't worry, you're going to be here. You're going to be a part of the event where it's catered to making sure that you can see those neighborhoods that you're investing in. So you're good from that perspective. And if you would like to go by and see your home, you can do that. We ask that you reach back out to us, talk to your client service portfolio manager here at JWB, give us a heads up to make sure that we can make sure everything is good for you. And if you happen to drive by, please do not disturb your resident. Please do not disturb your resident. So just a word from the client service team. And beyond that, we are super pumped. Can't wait. It's a week away. So can't wait.
We're doing the walkthrough tomorrow. Super excited to really nail this thing in. Everybody coming in town. It's going to be a really good time. Super pumped to give 1,000 hugs.
Yeah.
And I'm super pumped to connect face to face with the folks that have become famous through a little tradition that we have, which is called what? What do we start with, Paul?
Roll call.
The roll call, baby. We start off with good man. The MVP's in the house.
Lee Bishop.
Everybody's heard of him. The Ringmaster is in the house.
Drew Barnhill.
We got the patron Santorios of Northern Virginia.
Michael Santorios.
We got our leadoff hitter batting fourth today.
John Henning.
Cleanup. We got the Shawman in the house.
Nadeem Shah.
We got our friend that used to be from Milpitas, California. Now he's rocking in Rockland, California.
Lewis Hudnell.
Famous Steelers fan.
There we
got Marilyn Cotterman from Homosassa, Florida.
That's the home of the manatees, Pablo.
Manatees. You ever swim with a manatee, Paul? Don't worry about that. You don't have to answer that.
We got a manatee. I've never even seen a manatee. It's impressive.
Oh, manatee.
Go to Homosassa.
You got to go to Homosassa. Maybe we do the next one there. All right, we got the fairy godmother in the house.
Miss Jen Filson.
Miss Jen Filson. We got our favorite name to pronounce, Aaron O'Neill.
Into the light.
Good to have you, Aaron. We got our regulars, Rosalind and Gary Riley from Marietta, California.
We regard you.
We've got Alexis Hall in the house welcoming. Hello, Alexis. Good to have you. Is that a new name?
I think it's a new name. Welcome to the party, Alexis.
Make yourself at home.
Let us know how you came to be here.
We got not a new name, Stephen Chmielewski.
Fantastic. Becoming a regular.
World famous author. Stephen Chmielewski.
That's true.
Right?
That is true.
He's got a book coming out. We know that. We got Vincent Barbarite, another regular in the house.
There we go.
Good to have you, Vincent. We got the Mama Bears in the house, of course.
Cody Adams.
We got Pamela Hill from San Diego, right down the street from you there.
All right, Pamela, welcome to the show.
Who else we got in here? Rachel Bum from Hotlanta.
All right, Rachel.
Coming to the
What's
summit.
Rochelle?
We got Rochelle and Eddie, both from Hotlanta.
Wow, what do you know? Hotlanta presence.
Back to back. Hotlanta president, go Outcast. Big fan. We got our favorite amigo,
Bill Shields.
Bill Shields with a Buenas tardes, amigos. Muéstrame el dinero. We got Mark Sauer from Cincinnati, Ohio.
All right, Mark.
Mark. We got the
Billy Green.
from the effably ineffable mountains of Colorado. Keep trying, Bill. Keep trying. We got the Johnsons in the house.
There we
also
go.
from Colorado.
Top 10
Joy.
attendees for the show last year.
Top 10. We got Reggie Fonse.
All right, Reggie.
From the Inland Empire. Good to have you. Charity Graham saying hi, everybody.
Welcome,
Good
Charity.
to see you. We got our friend from Spain, all the way from Spain.
Miguel Angel Sanudo.
Miguel Angel Sanudo from Granada.
Fantastic to see you,
amigos. Good
Miguel.
to have you. Our boy Luis Olivares from Miami, which is like the Spain of North America.
That is true. That is true.
We've got who else we got out here? All right, cool. We got the first family in the house of the Not Your Average Fest show. Ken and Carolyn Moline, the patriarch and matriarch. We salute you. All right, let's kick this off. Fellas, last I checked, what we are talking about here is single family homes in working class neighborhoods. And we're going to ask whether, like debt or finance or cash, why do the rich choose debt? But I've got a bigger question than that. When I think of working class homes in workforce housing in like around an urban core, single family homes, and I think of the rich, normally when I hear the rich, I'm thinking angel investor, Silicon Valley tech, or like these, bigger kind of like, big money deals, like what's going on in downtown Jacksonville and stuff like that. Do the rich buy single family workforce housing? Paul, what's your answer to that?
1000% yes. Right. Well, absolutely. I mean, I like to not have to be smarter than everyone else. And I like to not have to be faster than everyone else. Why I love real estate. Real estate is a nice, slow moving target, but also success leaves clues, right? All you have to do is go and Google, how many single family homes Blackstone bought, right? One of the biggest, most successful, whatever they want to call them, hedge fund institutions, whatever they are. What was it? $17 billion, Greg, a couple of years ago that they put in single family workforce housing, the blue collar neighborhoods that I love, so that I grew up in, right? That I still live in for the most part, right? Like I love being around my neighbors, and those are the neighborhoods that absolutely wealth is created in those neighborhoods, and the wealthies absolutely buying single family home workforce housing. They always have, and kind of always will, because it's very steady and very predictable.
Yeah, and I'll add on and sprinkle some additional stats on there, because the wealthy have always invested in single family rental properties. You've probably heard this. People know that real estate is a vehicle for the wealthy to be able to grow and maintain their wealth. But the way that the wealthy and at the rate at which the wealthy are investing in single family rental properties is staggering.
Interesting.
Because prior to just, a few years ago, the way that people bought single family rental properties is maybe the traditional way, right? Where they go and they buy an individual asset, and they maybe build up a portfolio of properties. But what they didn't do is they didn't invest through Wall Street to be able to invest in single family rental properties. But now this asset class is front and center, is a darling of the Wall Street community to the tune of $110 billion put into play from Wall Street into single family rental properties. And, the rich, of course, invest in Wall Street. These are generally accredited funds that people are investing through, some of the big names like Blackstone and Invitation Homes and American Homes for Rent, some of these major players here. Well, the rich are investing in these vehicles to the tune of $110 billion. That's coming to this asset class. And you may have heard the term build to rent.
Mhm.
Well, when build to rent became a phenomenon and Wall Street started getting into it, it created an asset class that was not there previously. And so wealthy individuals have always been investing in rental properties, generally the way that we talk about. Maybe that's buying them in a traditional way or buying them with a vertically integrated company like a JWB. But in addition to that, there's now a preponderance of wealth that's going into this asset class specifically, much in the same way that apartment complexes became a Wall Street vehicle for wealth back in the 1980s. We've seen that now, call it over the last decade here in single family rental properties.
Interesting. Yeah. I'm a big fan of these like context changes, and when you see a certain group of people moving a certain way, it's just a foretelling sign of like what's coming and all these kinds of things. I remember if you look up Warren Buffett single family homes, right? Like there's a video that went pretty viral of him being like, if I was going to buy one thing right now, it's single family homes, work for, like that type of thing. And the sense that I get, or at least, I see the world through my own experience, and I'm a youngest child, so I'm very egotistical, but I didn't really know about this idea of being able to do it passively, right? Like I also have to assume that as you guys kind of famously got on the map, front page of the Wall Street Journal, because you invented this like infill lot, build to rent, vertically integrated model. And this idea of turnkey rental property investing being something that not everybody had heard of, and then taking it to the next level of like fully integrated, vertically integrated rental property investing. It seems like it's becoming easier to buy single family home rental properties. That's why before the wealthy were the only ones that could afford it, but now it's becoming like a thing that more and more people have more eyes on. It's becoming more possible.
Yes, and the advantage to doing it the way that it always has been done is that everyday investors could become wealthy through acquiring a portfolio of single family rental properties, and companies like a JWB or other vertically integrated companies have focused on making this easier, making it easier to get into this asset class. Because it's still challenging to do it the Wall Street way. You got to be accredited, which means you have to make a ton of money, and not everybody meets those thresholds. And you have to invest a ton of money. A lot of times your minimums to invest are hundreds of thousands of dollars there. So there's a number of different ways now, and you're seeing wealthy individuals and those who want to be wealthy starting to have more access, more opportunities to be able to create the portfolio that's based in real estate.
Makes sense. So that being said, this business model is at JWB is made to make that easy for the average person, right? But you can become a not your average investor by going to chatwithjwb.com, get that conversation going, and you can buy in on this asset class at the wealth you're doing. And before we get into, since we have our Fortune Builders community here in the house, I know that you all are used to these teaching seminars. We're more of a show, so we have a conversation. We're going to have a little bit more of a conversation, and then we're going to get into the teaching stuff, because I think just from a high level, this idea, let's conversationally answer the why do the rich choose debt when these homes are worth $250,000 here in Jacksonville, Florida. I'm somebody of $40 million worth of net worth. I have 250 grand in cash, so I can just pick up this house and not have a mortgage payment on it. Paul, why are they choosing debt? Why do they not just put that cash down and pick it up like that?
Yeah, absolutely. It's a great question, and the reality is, all cash purchases have their place. They still happen, right?
True. Yeah.
But they are used specifically by most, and we're making some broad generalizations, right? I don't want this also to be an us versus them of what do the wealthy do, right? I want this to be very inclusive, so we're all understanding we can take these same tools that what we're calling like the wealthy, like these big institutions and these crazy ultra high net worth individuals. What we're trying to do is just share those concepts with everyone, not create like an us versus them here. So everyone here in this community, we all have the same tools. That's what we're trying to drive home. We can use the same tools that the ultra high net worths are using, right? And sometimes They do use cash. But the reason they would use cash and just plop down that $250,000, like you said, Pablo, in that example, would be to be a very safe, very secure, very steady, kind of lower growth type of set it and forget it type of thing. They're not looking for any kind of real explosion, any kind of big growth from that. The kicker is, and what I was taught early on by Than and Paul, who fit into that ultra net worth crowd, is they taught me that debt is an accelerator, right? It's a huge accelerator. And I didn't quite understand that. And we'll unpack that today with Gregg, which will be great. We'll show some live examples and case studies. But the reason that one of the best financial concepts that the wealthy have learned, the ultra high net worths have learned, that we can use as well too, the reason that they use debt is because it accelerates most of our investment objectives, right? It can accelerate and increase our cash flow. It can accelerate and increase our long-term gains as well too, through two different things, taking advantage of compounding interest and accelerated pay down, which is great. We'll get into that in a bit. But here's the thing is, I think what the ultra wealthy have done, and we've done a really good job of teaching their future generations, and what we want to make sure our community has as well too, is that knowledge to unlock a bit of the stigma against debt, that debt can be a good thing, not necessarily a bad thing, right? Because if used properly, right, it can really accelerate your returns. And that's the concept that they use tremendously well, and that we want us to at least have the ability to use and the knowledge of how and when to use. Gregg, you agree?
100%. I think there is a way, a risk mitigated way to use debt to your advantage that can separate you from the average investor. But it can also be misused, right? That's where financial education and resources in a community come in place to make sure that you're on the right path to do that. So it's like most things. It's not one size fits all, and it's not one is definitely better than another. But I think the nuanced point is knowing that people have the money to buy it all cash. Why would you still choose to not buy it all cash? Because I think there's a lot of learning lessons in that point right there.
Yeah, and I think speaking of learning lessons, we got this presentation put together. We're gonna talk about both sides of it, like what the pluses and minuses of it are. But yeah, good nuance, right? We're not saying that the rich only do this and like whatever, right? Like they do both, and there's a place for both. I can think of, for example, in our community, we've got Ken Moline, started investing in his 80s, was kind of like upside down in his economics for his retirement, took a jumbo reverse mortgage on a home that he owned in Silicon Valley that he's had forever. And with that, put that loan to work for him in purchasing, was it like one house cash and another couple houses debt? So it upped his cash flow. So he kind of like used debt in multiple ways and bought cash at the same time, right? So there's many ways to skin this cat. It's why the whole financial engineering thing really, really works. I'm starting to really understand that, like, I tell people when they're asking me real estate advice, because I get to sit in this seat, it's like, listen, man, I don't know like everything about real estate, but I'm really starting to understand that the power is understanding this financial engineering game.
Yeah.
And it's just knowing all the different options that you have, because then you just go out and find a partner to execute for you.
And that's absolutely key, what you just said. I want to drive that point home, especially for all my Fortune Builders folks, because they're used to hearing that, right? Like financial education is the key. And that's what this next 40 minutes is really going to be all about, right? Is what give you those financial education pieces so you can digest them and use them. And then the key is then when you really understand it, you can apply it to your unique situation, right? And that's when financial engineering becomes custom to you. You know the different tools that are in your tool belt now. Take a diagnosis of your situation and then pull out whatever tools we need for your unique situation to help you get where you're wanting to go. And that's the beauty. That's why you need to jump on the phone, very point blank. If you're not doing that, you need to do that, right? You need to make sure you're getting that knowledge, which you're here today. Love it. Step 2 is start applying it to yourself, right? And get on the phone with J2B, chatwithj2b.com. Excuse me, I got a frog in my throat because I got a 4-year-old and it's February. Excuse me. But that's why we have them there. I mean, Gregg, you have a whole team of experts whose job it is to help apply these concepts to everyone's unique situation, right? And that's the beauty of it. I want to drive that point home.
100%. It's probably started, your education has probably started before here, but it continues here, but it doesn't stop here. You have to connect to a teammate, to a resource who has done it before. And for many of the Fortune Builders community, you know that I was the original Fortune Builder student back in the day.
The OG.
Yeah. Well, guess who I called who had done it before to figure this stuff out? I called Than, right? I called Than, I called Paul. And, of course, our relationship has lasted almost 20 years and will continue for forever. But it was the same model. It was, okay, I understand this. Now I need to reach out to somebody who's a little bit farther ahead than where I am in this specific part of my life. And for many of you, JWB can be that resource when it comes to rental property investing. So you should reach out. You should jump on a call, chat with jwb.com, or you can just send an email, info@jwbcompanies.com, and we'll get up a call scheduled.
We actually had an anonymous attendee say that they had to jam and to say it again. So it's chat with jwb.com. You can schedule it directly there, or you send out an email to info@jwb. All right, let's get into the teaching session. Good clarification, fellas. This is step one, financial engineering, understanding the information. But first,
well, listen, anytime that we're about to start showing you some actual numbers, which are based on estimates and based on historical assumptions and assumptions going forward, guess what? None of this is guaranteed, and you should do your own due diligence. We're not financial advisors. We're not offering financial planning advice, all these things that you probably know already. So do your own due diligence, start here and continue that conversation, and make sure that you're in a place where you've consulted those that you need to before actually putting money down on something, which is good advice wherever you go.
Agreed. So speaking of good advice, you also want to understand the fundamental asset class, right? So before we get into this financial engineering piece, by the way, before I forget, I'm going to start calling you the OG, the original Gregg.
There you go. Okay.
Okay. So this is a typical property that is in inventory right now. We wanted you to just put eyes on this thing. We actually, believe it or not, about 35% of investors with JWB purchase from being on this show right now. So
amazing, right?
Yeah, which is really, really cool. So this is normal to check it out, look at the numbers and go to chatwithjwb.com. But GC, why don't you tell us what we're looking at here?
Yeah, for all of our veterans, our Not Your Average Investor community veterans, you've seen this for many, many, many weeks.
This is what we used to call the JWB rental property of the
week. So we do bring it back every once in a while, and I thought this would be an appropriate time. So as Pablo mentioned, this is an asset, and I think this helps kind of make this tangible when we get into the debt versus debt versus cash concepts. We could be talking about it on this specific asset, but at the end of the day, these are what we fill our clients' portfolios with: single family rental properties here in Jacksonville, Florida, focused in workforce housing neighborhoods. And these are some of the high level details that are very representative of the entire portfolio that we have. This is one asset. Of course, there's more, but you can see here your purchase prices. On this one's $228,000. Purchase prices range from about $180,000 to about $280,000 here in Jacksonville, Florida. So my friends in San Diego and other parts of the country where home prices are way higher. That wasn't a misstep there. Home prices obviously are lower here. The median home sales price in Jacksonville is about $350,000, $360,000. So you can see that's what workforce housing means. You're right below middle income. That's the sweet spot. That's where you want to be for maximizing your 5 profit centers of rental property investing.
Got it. So just kind of for our friends that are listening to this on the podcast, because we publish this later on the podcast, purchase price of $228,000, monthly rent about $1,373. It's a 3-bedroom, 2-bathroom home, 1,230 square foot. That's rented already. Projected rent price appreciation year over year is about 3.6%. Projected home price appreciation, which is why people come to Jacksonville, because it is the best in class home price appreciation in cash flowing markets, is 4.8%, which ends up with an IRR for this one is 11.96, just a clip under 12%. But there's something special happening right now that also adds to that specific IRR, right? Do you see?
Yeah, 11.96 is higher than our typical returns are. And the reason is because of the incentives that we are offering right now that will likely be going away in the future. So we do offer an incentive here, which is our rate buy down incentive. And because interest rates have been higher, especially over the last couple of years, we have done everything we can to help our clients achieve a very low interest rate. And so even though interest rates have come down over a full percent just in the last couple of months, just on their own, we're still offering this incentive, and it equates to about a $5,500 savings for the client. And that's available for all properties that are put under contract at this time. But I can share with you, as interest rates continue to come down, which is what we're expecting, we're not going to offer that rate buy down incentive at some point in the future. So certainly something you want to take advantage of. And then the other discount that we do offer is what we call our bundles. Our bundles discount, right? So for any client that purchases 3 homes or more at a time, the discount is $5,000 on every home. So I had a personal friend who just acquired a portfolio of 7 properties that I helped him with, and 7 properties times 5,000. He was able to pocket $35,000 of cash flow because of that multi-purchase, that bundles discount. So that's available now as well.
There you go. So reason to go to chatwithjwb.com to take advantage of that incentive, right? Like you're selling a $1 million property in San Diego and you want to come over and pick up 3 of these homes or 5 of these homes because you can finance it. Then you also get $5,000 off per home plus these incentives. Go to chatwithjwb.com. Paul, I know that you own a handful of these and your dad owns a handful of these. What do you think of that purchase price over there? $228,000.
I mean, it's amazing, right? I grew up here in California, and $250,000 wouldn't even get you half of a garage, right? So it's always amazing to me whenever I see one individual property for anything less than $500,000 in my world. It's like, wait a minute, what part of town? But I own a bunch of these. My dad owns a bunch of these. If you've been on previous shows, you know my dad's getting ready to retire. We're selling his dental practice. We're selling his house. We're actually helping him move out to Palm Springs. And he's able to do that specifically because a lot of these single family homes that he's bought, and I have bought for him and gifted to him over the years. And yeah, I see these and they make me smile because when I see these, the mental and emotional reaction I have is like, oh gosh, my dad's able to retire off these. Oh gosh, I have time, freedom, and ownership of my own time because of these, because I have passive income coming off of a whole bunch of just these, which is amazing. I love it.
Love it, man. Love it, love it. All right, so let's get into the meat of this instruction. So this is the numbers of an all-cash purchase. For this example, we're using $240,000 for a purchase price. That means down payment plus closing costs. GC, all right, so I'm just going to kind of rattle off this number. Down payment plus closing costs of $236,700. Net rental income in year 1 is going to be $11,358. Net rental income in year 10 moves up to $13,188. Home price appreciation years 1 through 10, $108,497. Total profits in 10 years is $230,000, 408. That is a total IRR of 8.4% with an all-cash purchase.
There you go.
Yeah. So my first question is, why in an all-cash purchase is this like down payment plus closing costs, $236,000?
I thought you might ask that.
Yeah.
Well, that is the incentive that we're talking about at play. So for your cash purchases, one of the reasons that folks would gravitate to a cash purchase if they have the ability to do that is because your closing costs are a lot lower. And so your closing costs are estimated to be about $1,500. Well, when you have roughly a $5,500 incentive going your way, that in essence brings that your total investment down. Even though it's $240,000 purchase price, your out of pocket would actually be less if you take advantage while that incentive is still in place.
Got it. Paul, can you explain the type of person that buys all cash? This like 8.4% IRR. Is that still a good investment? Are people going away from that? What would be the reason to buy this thing all cash?
Yeah, I mean, very bluntly, if you're a Wall Street hedge fund manager, or you manage millions and millions of dollars on Wall Street and you're able to produce an 8.4% clip, you're getting a huge bonus. You would get a massive bonus if you're on Wall Street creating an 8.4% return for your clients. Huge bonus, right? You'd be doing backflips, right? So absolutely. The investor who's looking for this, again, I think it comes down to investment objectives. If you're looking for an all cash purchase, you might have a shorter timeline, right? And you might have a situation where you're, a little bit more advanced in age, right? You have a 1 year, 2 year, 3 year timeline to really reap the maximum benefit from your investments, because leverage really shows its true colors and shows its massive advantages the more time you give it, right? And we'll get into that in a little bit with Gregg. So if you have a shorter timeline, you are insanely risk adverse, not insanely, but I'd say dramatically risk averse, maybe out of a scale of 1 to 10 on a risk scale, maybe you're a 1, right? Maybe you're a 2, right? Because anytime you do factor in debt, you are taking moderately risk. We can absolutely adjust for that risk 100%, but let's call a spade a spade. When you add the factor of debt in, there is a slight risk, maybe a point and a half. Maybe you're a 3 or a 4 on a risk scale. debt's absolutely appropriate for you. But I know my father took him a long time to get used to the concept of debt. And we started with some cash properties. He saw how it went. And then we were able to introduce debt once he felt he had the security in place of those all cash. And then we used the debt to really accelerate things and financial engineer, right? So that's why someone may be more comfortable to start with an all cash purchase, right? Shorter timeline and investment objectives that match up to that, right?
Makes a lot of sense. Anything to add to that?
No, I think you nailed it.
Yep, totally nailed it, as is tradition around here. All right, so let's go. That's all cash purchase. Now let's look at what happens with a 25% down payment. Same purchase price, OBS, less down payment, $68,600 because you're only having to come down with 25% plus closing costs. Net rental income in year one now is slightly negative, $1,200 at the end of the year. Net rental income year 10 is positive, $577. Home price appreciation in years 1 through 10 is now $96,597, and your total profits years 1 through 10 is $116,000, but the IRR shoots up from 8.4% to 9.9%, almost 10%. GC, what's happening here?
This is the number one reason why the wealthy would choose to use debt while purchasing a property, because wealthy folks and we all should aspire to make decisions based on our return on investment. And when you are able to use a 25% down payment, that means you're using somebody else's 75%. You're using the bank's money, you're using other people's money. And what you're able to do is to control and own an asset, but only put a fraction of your own money into the deal. And the way to calculate your return on investment is not how much money did I earn over the purchase price. It's what is my return on my investment.
Mm-hmm.
And so that's why you're able to take an asset that is worth $240,000, own it, control it, get all the benefits from it, but you only had to put $68,600 into it. And through those profit centers, you're able to grow it to the tune of over $116,000 over 10 years. And so that delta from $68,600 to $116,000 is a better return than the all cash purchase, which may have beefier numbers, but required a much more capital intensive approach to get into it.
Got it. Anything to add to that, Paul?
Yeah, I think this is someplace we should pause and sit in, and people should really think about, because some things jump out to me, right? And I've said it every show, and I'll continue to say it every show. Understanding your unique investment objectives, what you are trying to do, is key to this whole thing. What we're trying to do is provide the financial education, like I said earlier, to give those tools in your tool belt. You pull those tools out to achieve results you want. The tool of leverage here, what we're showing is what does that provide? Well, it provides you exactly what Gregg said. Your nest egg isn't in one basket now. Your nest egg is spread out through a lot of different baskets, right? So that provides a little bit of, in my opinion, lower risk, right? You can put $60,000, $70,000 down on a bunch of different properties and have a lot of engines that provide you cash flow and returns, right? Rather than one engine. I like that concept. Many people like that concept. What else does it do? Well, it accelerates our growth and our returns. My dollars are working harder for me in that engine, in that chess piece that's on the board. And when I have multiple different ones of those versus one, I have more chances to win, right? Let's just break this down really simple. So that's one of the reasons why the wealthy do this, right? Get as many chess pieces on the board as they can. That's what Gregg talked about, of controlling the asset for as low down payment as you can. What does that do? It gives you more chances to win, right? And what do the wealthy do? They win a lot. You may lose sometimes, yes, but if I have more different chess pieces across the board, everything has risk, but if I can spread my risk out, absolutely a win, right? Absolutely one of the tools the wealthy use. The other thing here that's important to understand is what we need to understand is what's a lot of the wealthy's investment objective. Again, we hit this on the last show and it brings up again. The objective isn't necessarily short-term profits. The objective isn't necessarily short-term cash flow, right? Because what the market is providing us right now with the interest rates the way they are, with prices the way they are, just in the economy as a total with inflation, cash flow is being a little bit squeezed compared to where it was 5 years ago, 10 years ago, 15 years ago, right? So if our objective doesn't shift along with what the economy is, we're going to miss the boat a little bit. You're going to not have the full education to make decisions that's best for you right now in the economy we're in. We all can lament, oh, I wish it was 2008 again where I could buy everything at crazy discount. We're not there. It's not where we are, right? The economy is where it is. What's the best decision we can make right now for us to help us get on the path to where we want to go? So if the objective is you can wait 5 years, 10 years, and you don't need the cash flow coming in from this, which is a lot of the wealthiest situation, the returns are absolutely better overall when you use leverage, right? So it's understanding and starting to apply, well, why would I do this? Well, it accelerates my overall returns. It allows me to spread out my risk. It allows me to have more chances to win, right? A lot of these things you're starting to understand, oh, okay, I get it. 25% down, I may get maybe a little bit lower short-term return, but my long-term return is absolutely where I want to be, right? And we haven't even got into principal pay down and compounding and all that stuff with Greg. I'll let you get into that.
Well, if you're going to give me that softball, I love talking about the 5 profit centers. Should we go into the 5 profit centers?
By all means.
All right. Well, there's 5 ways that are contributing here to result in that total profits thing. And if there's one thing I've heard consistently through speaking with literally tens of thousands of investors over the last 18 years is that they really focus on cash flow when they're at least evaluating a property right off the bat. It's the most common thing. But what is lacking from an education piece is if you actually own real estate and you hold on to it for a full market cycle and you look at the end, like I own real estate now for over 18 years now. And I look back at those purchases that I made 18 years ago and I say, how did I get these profits? And was it cash flow? Was it the other profit centers, which we'll go into? It was not cash flow. It was the other profit centers. And actually, the biggest driver of your total profits when you actually own real estate for a full market cycle is home price appreciation, which most investors say, oh, I don't want to count on that. I don't want to think about that. I can't count on that. So there's a missing education piece on 2 levels. One, cash flow is not the biggest driver of your returns over a full market cycle. And number 2, that you can count on home price appreciation given a long enough runway. And so when you combine both of those education pieces, your perspective starts to switch. The way you make decisions starts to switch because it's more in line with what's actually going to produce a better outcome for you over the long haul. So with all that being said, there's 5 ways that you get paid when you own a rental property. There's cash flow, which we just talked about, right? It is important. It's like the entrance to the dance for many people, right? We want to have an asset that pays for itself every single month, and that's what we can create for you. But there's an overimportance on cash flow that many newer investors cling to. And so we need to be more open-minded than that. Next, there's tax savings. So you get incredible tax advantages by simply investing in this asset class. It's available to everybody who invests in this asset class. You don't have to have a certain criteria. You don't have to have a certain job. But what this does is defer the taxes that you need to pay on the income that you earn, which is amazing. We love that. Then there's principal pay down. There's this concept that when you take this loan out, it's not you who's paying the loan back. It is your tenant or resident. We call them residents, right? It's your tenant or resident who's paying that monthly mortgage payment for you. They pay it to you in the form of rent, but in essence, that pays your loan back for you. So that's the principal pay down component. And guys, that adds up. After 10 years or 18 years or longer than that, you take a look at your loan balance and it didn't come out of your pocket, but hundreds of thousands of dollars of value created there. So a huge and misunderstood profit center there. Then we have home price appreciation, which we can talk a little bit more about if we'd like. But at the end of the day, it's the biggest driver to your returns. It's the biggest piece of the pie. So we need to focus on that for sure.
Yeah, totally. I do want to talk about home price appreciation, right? Like when Greg is talking about the biggest piece of the pie, and we've done a bunch of these. So we have these different segments on the show. One is this, we have to like a rabbit of the week. We do like a portfolio of the week. And then we also do a guest investor of the week. And we bring on past investors that have been investing with JWB. And we always break down the returns based on, based on the different profit centers. And we make it a pie, right? We make it a pie chart. And what you always end up seeing is it looks like a Pac-Man, right? Like it's like a Pac-Man, and every other profit center is the mouth of the Pac-Man, and home price appreciation is the Pac-Man itself. Some people it's like 90%, other people it's like 60%, right? But it's always clearly like either a Pac-Man with its mouth wide open or slightly open.
Mm-hmm.
And that's kind of like when we talk about piece of the pie, home price appreciation. Speaking of home price appreciation, there is a couple people that have asked in the chat, why is the home price appreciation in the all cash different than the home price appreciation in the down payment?
Our community is so savvy, and I'm so glad that you guys asked that question. The difference is the closing costs. So when I prepare this, I try to condense some things to save some space. So I put the amount of closing costs and factor that into what your net home price appreciation is. And these would be closing costs on the buy side or the sell side. And so on a cash purchase, there's less closing costs. And then on a 25% down payment purchase, there's more closing costs to the tune of about $12,000 more. So that's the difference there. Your home is actually appreciating the same, whether it's a cash purchase or if you use financing, but I'm taking into account the loss from incurring the additional closing costs, and that's what's factored in there.
Interesting. Okay. We've got another good question here in the chat. It says, Pamela Hill says, so initially it will cost, and by the way, we're going to go through this at like different percentage costs that we put down, different down payments, but Pamela Hill's for this one. So initially it will cost us $1,247 the first year. You won't be making money, which she's talking about this idea of net rental income year one. What do you have to say about that, GC?
I think that's accurate. And I put this as, there we go. I put this example out here to show that point, right? A 25% down, like Paul was talking about in today's interest rate environment and today's purchase price environment, you're typically not getting positive cash flow for investing in a passive income stream with a vertically integrated provider. You're probably not. Now, that doesn't mean that it's the right thing or the wrong thing for every investor. For some investors, they still put 25% down. But what they do is they have other income to offset the cash flow deficit that they have. Now, why would they do that? Why would an investor go in and purchase a home that doesn't pay for itself every single month? Well, if you look down at the return on investment calculation, it's a better return on investment, even though it's negative cash flow. So it's pretty rare right now for a client, especially a newer client. Generally speaking, we're not going to put 25% down because we can, and we love to set up investments right off the bat that pay for themselves every single month, which would require a higher down payment. But for some of you out there, it might make sense if you're a high income earner and you have more than $1,200 a year that you're able to save right now. It would make financial sense for you to take a $1,200 deficit of cash flow in the first year if you can have a bigger pile of money at the end of the market cycle, which you would for a 25% down payment, even compared to 30 or 35.
Yeah, the other example you've given me is, again, this is for not a first-time kind of investor, but if you've already been buying homes with JW and you have 5, let's say that you've had for a while, you have, call it $1,500, $2,000 worth of passive income coming in every single month, and you have X amount of capital, you can add another home to your portfolio and have that, monthly cash flow pay for it. The way that I look at it, because I'm not a high income earner, I'm not a yet. I'm not somebody that has like 10 properties that are all super cash flow positive. I just got to my 5th door, but there is other things that I have invested in my entire life that take a little bit off of my paycheck every single month.
Yeah.
Right. So like we are used to taking 5%, 10%, 15% automatically from our paycheck to put in other asset classes.
We are.
And if you think about it this way, right, like, and they tell you those asset classes may or may not be giving you 10% back, right? So if you just think about it in dollars and cents, the idea of setting aside savings to go into long-term investing is not a foreign concept, right? So if you think about it that way, it's like, yeah, sure, Pamela said, you're not making money, but this, at the end of the day, is a bucket of, long-term investing that you're thinking about to create wealth and to create cash flow down the line, right? So by the time you get to year 10 in this scenario, you are in positive cash flow. And, at this point, I think we can just kind of like put the other ones up there and talk about this idea that the more you don't, we went with 25% down to do the biggest juxtaposition, but if you put 30% down, you're still slightly cash flow negative in year 1 and you're way cash flow positive by year 10. If you put 35% down, you are cash flow positive year 1 and wait, and it continues to go up. And likewise to everything that we explained, the more you put down, the lower the IRR is by year 10, but at the same time, it's also the higher the cash flow. So that is the thing that we're thinking about here with the financial engineering of like figuring out what are the, what we put in, right?
And that's a great point. If I could jump in, Greg, and what you just said, Pablo, is huge, right? This is financial engineering at its finest, right? And I'm glad someone asked that question so we could drive that point home. Debt and leverage, which is what we're talking about here, it's a tool, right? There's no one way to use it. There's no wrong way to use it or right way to use it because everyone's different. The key is understanding, okay, I can use leverage and debt. What it does for me is, like we talked about, more chips on the board, more chess pieces, spreads out my risk, accelerates my overall returns. Well, if short-term returns are also important to you, well, let's use the appropriate amount of debt for you in your particular scenario, right? This is the customization piece that's absolutely vital, right? And what I love about the Fortune Builders community, I love about the J2B community, this is why I love mashing them together and getting everyone together in one happy family, which I love, is because we understand it's not just the education piece, which is what we're trying to give you here. It's that secondary piece of applying it to your unique situation. And that's what you all are so good at. So I want to use an example to drive this point home, if that's okay, right? So everyone can go on this little journey with me, okay? My portfolio, as I use an example, I started buying about 10, 15 years ago, and I had a very cash flow centric mindset and I had a very cash flow centric portfolio, okay? Fast forward 6, 7 years, right? My dad gets sick and I needed to take a lot of time off and he got a lot of medical bills, right? That cash flow was really, really important. But what I decided to do is I said, okay, wait. I also have a lot of equity built in. That line right there of home price appreciation, right? That 96,000 number, I was starting to accumulate there. Now, I wasn't all the way 10 years in on a lot of my properties. I was 4 years in, 5 years in. So I had, roughly half of that 96 number on a lot of my properties in built-in equity. So everyone with me so far? You guys get this, right? I had equity building up, but I hadn't been able to get it yet, right? It was in there. It was in the property, but it wasn't in my pocket. It didn't help pay for my dad's surgeries. It didn't help pay for things. So what I was able to do was say, wait a minute, let me restructure my loan and restructure my debt and go and get some of that equity, right? That's a tool we can use. That's what leverage can do. Let me refinance my loan and get some of that equity so I can pay for my dad's surgeries, right? I can make sure he has a nice room in the hospital. I can do all those things, right? I can get that money. Debt allowed me to do that. But there's a juxtapose with everything we do, right? The more debt we take on, sometimes that eats into our cash flow. Why? We have a bigger chunk of debt on a property. I owe the bank more every single month on that, right? But it freed up cash for me to go do things. And in this case, it was my dad. I wanted to take care of him. Could be you want to go sail the world. Could be you want to buy a country club membership. Could be you want to buy a nice fancy, whatever. That's what I'm trying to drive home is it's a tool, right? And it's important to understand how the tool works. The more debt you take on in a higher interest rate environment, you're going to have a higher monthly payment. It's going to eat into your cash flow. But long term, because we're using so little of our own money, when we sell it long term or we refinance it long term, 5, 7, 10 years down the road, you're maximizing your long-term returns. The more debt you use, you're minimizing your short-term returns, and vice versa. The key point here is your responsibility is to find where in that spectrum you want to be. Does that make sense, Greg? Is that point being driven home? Okay.
I love it. I think that's your responsibility. And I think it doesn't have to be as ominous or as challenging as it may seem to figure that out too.
Yeah.
That's where our team comes into play, right? If you want a plan built for you and we can sit down and understand what your goals and your resources are. And if you want a plan that says, I should have X number of houses and we should put 30% down on these houses, this one we should put 35% down and this one we should put 25% down. And guess what? Those houses, those 2 other ones that we're going to buy with all cash. We can sit down, put that plan together for you, and your retirement can be mapped out, right? There's not another asset class that is consistent and reliable through all kinds of weather as single family rental properties have proven to be, especially over the last 20 years. And so that can be mapped out. You can work with folks, you can build a plan, and then it's just execution. So don't feel like it all has to be on your own shoulders. I think the responsibility is for you to have some education, which you guys have done a great job by being here today and being a part of Fortune Builders and being a part of the Not Your Average Investor community. And I think the responsibility is to pick up the phone, right? And to reach out and start right there, because that's what we love to do. I think that's a big separator.
Yeah. A lot of different ways to do this thing, right? So it's just like understand the concepts and then have somebody that can like give you a couple different options. To me, that whole chatwithjwb.com, that is that experience, right? Is them kind of like fitting in for you individually what you're going to do. Let's jam through some great questions
Let's do it.
here. All right. The first thing is Gregg Stone, who we affectionately refer to as the better Gregg around here. Gregg Stone says, it would seem that this example should be a bit expanded since using leverage, you can easily buy 3 properties, but this isn't showing that, right? Like this idea that if you're going to buy an all cash purchase, you could buy 3 of these 25% down homes right off the bat if you're going to go all cash purchase. That's something else to think about, not just the fact that your IRR goes up, but you can get 3 of these IRRs.
I love it. I kind of see this being a foundational piece when we do more properties of the week and portfolios of the week and client journeys. So Gregg, there's a reason why you're the better. Great suggestion, and that's easy to do. And I'll add that to the repertoire.
Such a good Gregg. Such a good Gregg. All right. Bruce Nwogu says, so tax saving is the depreciation you take every year, 1/30 of the purchase price less land value, ?
Great question, Bruce. So tax savings actually is figuring out what the depreciable value of the building is. And I'll save you all the details, but just think about the building as what is able to be depreciated from a tax perspective, because it's going to break over time. So you get a write-off of what that amount is each and every year. And then we calculate that times your tax rate. And we calculate what that tax savings would be. And that is calculated based on when you receive income throughout the ownership period. So a little bit more than what you put in there, but you're on the right track for sure.
Cool. Vincent Burbright's got a question. In a recent conversation with a member of the JWB sales team, I was told that JWB requires at least 30% down as well as a binder deposit of $2,500 per property. Is that accurate? Thank you.
No, it might have been some missed signals there somewhere. There's certainly not a requirement for 30% down for a purchase. We're going to, of course, you can put 100% down. You can put as little actually as 20% down, which is what the lenders require. So anywhere in between there is something you can put down.
Cool. Anonymous attendee asks, so what is the difference with going through the passive income club with Paul and doing things directly with JWB? Paul, do you have an answer for that?
There is no difference. We are as tight as can be, right? We are, think of us as one big family, right? Passive Income Club is the education arm of Fortune Builders that is specifically designed to help give the financial education on single family rental property, right? Investment portfolio building, right? So that's what Passive Income Club is. How do we build a investment portfolio of long-term hold properties? Fortune Builders in general mostly is the education on how to flip, how to wholesale, how to be active. Passive income is, well, how do you set up something that's passive investment properties? Think of JWB as the execution arm of that. Passive Income Club is the education. JWB is the execution of that, where they have the properties. They are the operator that buys them, fixes them up, puts a renter in there, does all the maintenance and repairs and maintenance and all that stuff, and then manages it for you, and then gives you a great client service on the back end of that as well too. So JWB is the execution of the education, right? And so there is virtually no difference, right? Gregg, is that fair? I don't want to speak for your company.
You nailed it again, brother.
Yeah.
All right, cool. Miguel Angel Sanudo's got a question. Are you saying that the lower the down payment, the better? Saying differently, the more finance, the better. Miguel Angel, I think we can kind of answer that. We just talked about it, right? Like, I think you asked that beforehand, but it depends on what your objectives are. If you are maximizing for internal rate of return, and that is what you are seeking, then the lower the down payment, the higher the internal rate of return. If you need cash flow today and you need to live off of it, then you need to figure out how to get that, which is going to be higher down payments, maybe all cash purchase, so that you can cash flow that. Anything there, guys?
You just warmed my heart, Pablo. You gave my favorite answer ever. Anyone whoever attend one of my live events,
It
like in
depends.
Fortune Builders and my speaking on stage, they know, and the crowd knows by the end of those 3 days that my favorite answer is it depends. Right? It depends on you. So Pablo, you nailed that one, man. Nailed it.
And because it depends, that's why you need to reach out and talk to us, because if that question is going on in your head right now, you should be write down info@jwbcompanies.com, send an email. It's as easy as that. My team will set up a phone call with you and we'll help figure out the right answer for you, because you should be having a whole lot of questions like that churning right now. The next step is to start the conversation, and that's on you.
Okay, we got another one from Anonymous today. Will the slides be available after the webinar for us to go back and refer to? So this is live on YouTube right now. I can share that video in the chat. Actually, Cody, if you can share that video in the chat, that'd be great. We also publish this thing to podcast. We publish this thing to YouTube. So all the slides, you can relive all of this stuff if you go to the JWB YouTube channel. You can find it on YouTube if you put JWB, it'll send you straight here. If you put Not Your Average Investor Show, it'll send you straight here. So yeah, totally. Yep.
And I was going to suggest going to the Facebook group too. Go to jwbfacebookgroup.com. You can join the Facebook group and you'll see the clips there too.
Got it. I had another question here from Pamela Hill in the chat saying, how does this work for the more mature investors, 65 and older? Paul, what do you think? You're very mature.
I appreciate that. Yeah, I mean, the same answers. It depends, right? Because it depends on your overall financial situation. Because some more mature investors who, are in the 60 to 70, 70 to 80 range, it depends on their portfolio size. Depends on how much cash flow they have coming in from other investments. It depends on if they're still earning income, if they're taking Social Security, if they're like a lot of factors matter, right? The more direct answer is usually as we get older, what we usually like to do is maximize our more short-term returns because we have a shorter time horizon to when we want to see the returns of that, but not always. Some more mature investors come to us, come to Gregg, and they say, on their call, when they go to chatwithjwb.com and they schedule a call, and they say, I want to leave the maximum amount of assets for my future generations, right? Or I want to leave the biggest endowment for my favorite charity. I want to leave, so it's a very different, unique situation for everyone, right? So the situation where they come, hey, I want to leave the massive amount of income stream and long-term wealth building tools for all my grandkids. And I have 7 grandkids. Well, that's a very different plan than I'm 68 years old and I need to supplement my Social Security right now. 2 very different plans, right? 2 different types of leverage we would use. 2 different types of buying plans we would have, very different objectives we're trying to hit, right?
Well said.
Well said. Well said. Winnie Bean Amy says, does credit affect your participation in the program?
Having better credit is always helpful. It's another tool like Paul was talking about. But if you're going to buy the properties with all cash, then you don't need credit because you're not getting a loan. So, another great question. And if you have questions about, does my credit qualify? Am I going to be able to get a loan with this? Another reason to go to info@jwbcompanies.com, send an email to us, jump on the phones with us, because many times, especially folks that are more mature, a little bit older, they might not have an active income stream. They might say to themselves, well, I might not qualify for a loan. But that's not the case. Many times we're able to help people qualify with our lender base. So another reason to reach out to us.
Yeah, and I just wanted to clarify, since we have so many of you folks on the call today, welcome, by the way. I hope you make it a habit. We do this every Tuesday and Thursday. It's a lot of fun. When you say the program, I just kind of want to delineate that this isn't like a program. This is your asset.
Yeah,
right?
True. Good call.
JWB is bringing you these homes that are already performing. They're already rented because they either built it or renovated and put a tenant in there. They also have the biggest property management company in town. That's the most professional one. So you're going to want it managed by them, but you can, whenever you can decide to have a different property manager if you want. You can decide to sell your home if you want. So this is your asset. This is not a program.
Right.
You are investing in this thing the same way that you would buy another asset class.
Sure.
It's just that if we're going to give you the best advice possible, we're going to tell you, think about having this for at least next 5 to 10 years, and you're going to have a hard time finding a better property manager than JWB in the world.
Appreciate that.
Right?
I wear that badge. I like it.
Believe it. And yes, it's only in Jacksonville. We've had a couple of those questions here. You want to talk about that philosophy GC about Jacksonville?
Why Jacksonville?
Yeah.
Yeah, absolutely. Right.
Why you're only in Jacksonville.
Oh, why we're only in Jacksonville.
Yeah.
Yeah. You know, we have been approached many, many times. And for a long time, clients would say, oh, I wish you were going to this. I love JWB. I love Jacksonville. I wish you were in this other market. I wish you were in this other market. And for the longest time, I had this internal conversation was, how do I help people see that it is so much more to their benefit and to our community's benefit to go a mile deep rather than a mile wide, to where eventually I would get people, our clients and our community saying, I am so glad you are only in Jacksonville. And really over the last couple of years, that's what we're starting to see. You know, the reality is when you go to multiple markets, there's risk associated with a client's returns when you go to multiple markets. And that's not saying it can't be done, but the ability to set up this operation, which is 115 teammates strong and thousands of relationships here that allow this thing to work so it can be passive and enjoyable for you, it is naive and a little risky to think that you can just go and set those up in multiple locations. So I first think about the risk to clients, and that's why we don't do it. The next one is impact. And the impact that we can make by focusing our efforts on our city here and putting our flag in the ground, man, especially for those who are coming to the summit here next week, you're going to see the impact. And you just can't do that if you're spread across multiple cities. And then lastly, there's a team component and just a personal choice, right? We all live here. We have, you know, our teammates here that are, you know, building their families here. And in order to go to multiple markets, we would have to take some of our team. I'd probably have to go to a different market to go and set it up and what have you. And there's just not a whole lot of desire to go out there and chase a buck, to be quite honest. So yeah, for all those reasons, we're here. We've said it for 18 years now that Jacksonville is our home. People were surprised 18 years ago when we said it and we weren't going anywhere. Some people still might be surprised that I'm saying it today. 18 years from now, we'll be saying the same thing.
I got to say, as somebody that's from Miami that moved here 5 years ago, it also helps that you have had, you know, you get to be in the darling market, right? Like you're in the market that has been called by ULI the next supernova. You're in the market that over the last 15 years, it's been like one of the fastest growing markets in the US. You know, you guys as 24-year-old guys coming out of college 6 years ago, I think there was a decent amount of fortune in the fact that this is your backyard and you've been able to make all this stuff kind of work, which allows you to now completely vertically integrate into this like amazing market that has the highest growth rate in single family home appreciation, that also cash flow, and you've bought 20 blocks of downtown and you built a $200 million company that's been on the front page of the Wall Street Journal and wins best places to work every year too.
Yeah. Did you say I got out of college 6 years ago?
16.
Oh, okay, good.
Yeah.
I wish it was 6.
All right, so let's, Paul, you got a little bit more time, man, or you got to get going?
No, I'm good, man. Anytime I get on the show, I clear like my whole day for you, just off the off chance that, you know, you say, hey, you want to fly to Florida and play golf or something like that.
All right, man, let's jam through this real quick. Michael Santorio says, Greg, it's important to note that when you're leveraging your very little cash flow won't cover any unexpected repairs for a property turn. You need to be diligent and hold enough cash for these.
Absolutely. Regardless of the amount that you put down, this is sage advice. And another thing that we would do as we sit down with anybody to build a portfolio with them, we're not just going to talk about the capital that you need to buy it. We're going to talk about reserves as well, because this is setting you up for success. So again, another part of the portfolio planning process, the real estate planning process that we go through with every new client. And then we continue with our current clients to help them reach those goals.
Love it. Edward Sargent is saying, first timer here, green as can be. Great show. I'm hooked. Great, Edward.
All right.
You got a great community here. You're going to make a ton of friends here on this chat. Hopefully you come to the next summit. And I love the fact that you're new here, and I hope you make it a habit. We do this every Tuesday and Thursday at the same time. I think right now is kind of when people start kind of like popping off. If you got to go, cool. We got some more Q&A. Just so you know, chatwithjwb.com is the next step. info@jwbcompanies.com. If you want to make this personal, you want to take the next step in this thing, let's jam through a couple more of these. Tara Paget, are the profits shown including the sale of the property?
Great question, Tara. Absolutely, yes. This includes all costs on the front end, as well as all disposition costs on the back end, including your selling, holding, and closing costs. So it's those are real numbers there.
And Doug Ledrette has a question. Are you including the principal pay down as part of the net rental income? In other words, are you only subtracting the interest portion of the mortgage payments in this calculation?
We are not only subtracting the interest portions in the mortgage payment part of this calculation. We are including everything that would go into net rental income. So we are subtracting the mortgage payment fully, the principal and the interest. The principal payment section is the principal pay down section is a different part of the equation. And that's on a monthly basis, how much your principal is being reduced by your resident paying off your loan for you.
Susan Watson asks, during COVID, did you have any issue with renters not paying their rent? If so, what percentage?
Well, Susan, I appreciate the question. I wish you were with us for the last 3 years now, 4 years now.
We were on here during COVID.
Yeah, we were here. That's when the show really started, actually. It started in January 2020. So that was certainly a time that I'm very thankful that we could have been with our community as it was in its infancy at that point, and to share the COVID experience from a property management lens and from the people who are managing the money. We were able to collect 98% of rents all through COVID. And that number might surprise many people, but we shared those numbers month in, month out. We reported every single month. And, it's just a different perspective of how to solve a problem, right? Many people assumed that it was going to be difficult or hard to be able to collect rents in that environment where there were eviction moratoriums, but there was a whole lot of good that we could do to strengthen that relationship with our residents. Because at the end of the day, those rents were going to need to be paid at some time. It wasn't like a, get out of rent free card. And we wanted to make sure that we could set up, be compassionate, help our residents in their time of need, as we all needed some help then, but also perform for our owners in the long run. And it's one of the things we're most proud of, especially through that COVID experience, is that we were able to collect 98% of rents during that year.
All right. Last 3 questions and we're calling it a day. Nelida Taromina, I don't know if that's in Spanish. I just see it in Spanish whenever I see another name, asks, would we work with your mortgage lenders or can we work with our own?
Great question. You would be working with JWB's approved lender list. And there's a whole lot of reasons for that. At the end of the day, it's to make sure that your experience is top notch, to make sure that your loan closes. And it would be irresponsible if JWB allowed our clients to just use whatever lender that they wanted to, because at the end of the day, the way JWB keeps the lights on is to make sure that loans close and that properties sell. And so we certainly can't have that risk. But moreover than that, by working with JWB's lenders, you're going to get the best rate, you're going to have the best experience, and the customer service standards are going to be upheld.
Got it. I'm going to read this one in Spanish too, because it's George with a J. Jorge Flores says, what was the 5th profit center? We stopped at home price appreciation. What's the 5th profit center, Paul?
I'm going to let Gregg do that one. He's the one who taught me the 5th profit center.
I love it, man. I love it.
I'm going to let Gregg stand in all his glory here.
I just want to make sure you're feeling the love over there, buddy.
No, I appreciate it. But when the master is at work, you let the master go. And I got to say, Gregg taught me this 5th profit center, because I was like, as soon as he taught me, I was like, oh yeah. And it was like a light bulb moment. So Gregg, I'm going to let you live in your glory.
Thank you, brother. And good on you, Jorge, for figuring that out and paying attention there. That was some good stuff there. The 5th profit center is inflation hedging and inflation profiting. And inflation hedging is what happens with rental properties when you think about as inflation goes up, as we have seen over the years now. We saw inflation rise to levels of over 9% in our country, which is incredibly high. Well, what else did you see? You saw rents go up incredibly high. You saw home prices go up incredibly high. And so you have this built-in hedge against inflation when you invest in a hard asset like single-family rental properties. And what that just means is that as costs go up around it, it's more often than not the rents go up and the home prices go up to offset or maybe even profit from it, which is what our investors have seen, especially over the last few years. Inflation profiting is just to sprinkle on a little bit more than that. One reason why the wealthy would choose debt is inflation profiting, because with inflation profiting, you actually take the loan out, but as inflation happens every single year, which we know it does in our country, when you pay the loan back, it's over a period of years, and you're actually paying it back in less valuable dollars. And it's hard for people to get this concept, but just think about if you bought a house 30 years ago, what would your mortgage payment be on that home, right? It would be 0. It'd be like next to nothing, right? So let's say 20 years ago, just for this example, right? You still have a mortgage payment. You bought it 20 years ago, it's next to nothing. You would look at the amount of earnings that you earn today and you'd be like, oh my gosh, This is nothing. I would pay this down like that. And it's because your earnings grow with inflation, but the debt stays consistent. So you're actually paying it back in less valuable dollars. That's like a ninja trick of the wealthy. And another reason why they would choose debt many times to purchase a home.
This is why when Jordan is in town in his prime, you buy tickets, folks. Listen to the greats do the great things. All right, last question. Eddie Harris from Hotlanta. This one's for you, Paul. He says, great to see you, Paul. Eddie, I agree. It's great to see Paul. He says, what is your 1,000-foot view of where interest rates are headed in 2024? Thanks.
Oh man, he's buttering me up to then do my financial prognostication of where the economy's going. I love it. Great question. The answer is I don't know. And the answer is I don't think anyone knows except for Jay Powell, right? And that's out of my control, frankly. And I spend the majority of my time focusing in my locus of control, right? What are the decisions I can make now? What can I set myself up for the next 6, 12, 18 months, despite what interest rates do? What's my locus of control? Because what interest rates do, very frankly, are out of my control, right? And I need to be able to make money in both scenarios, right? I need to make money if interest rates go down, which most of the talking heads of the world think they will, right? So that's my answer. Everyone else seems to think they are going to go down. Very few people think they're going to continue to go up. So I need to be able to make money in that scenario. But I also need to set my portfolio up and make decisions and get the education. What happens if that doesn't happen, right? So I need to live on this edge of the coin, right? Where if both scenarios happen, how do I make money? How do I set my portfolio up that's bulletproof, right? So do I personally think interest rates are going to go down in, the next 12, 18 months? Yeah, probably. But honestly, it doesn't really matter because you need to set up your financial education. You need to set up your portfolio for both scenarios. How you do that is you make the best decisions now you can with the education you have, right? And so maybe not a popular answer. I'm not trying to dodge it, right? So directly, do I think interest rates will go down over the next 12 months? Yeah, probably. But it's out of my control. I focus on my locus of control. Right?
I'll add one thing on there. I think nobody knows in the short run, like Paul's talking about. I think over the long haul, we all know and expect that over the long haul, our country wants interest rates to come down. So I think the path to get there is not exactly known, but I think we will get there. And what many people don't realize is the effect of when interest rates go down, the effect on home prices. We actually have shows on this where I actually researched the last time that interest rates went down dramatically and the effect on home prices. And you see above average home price appreciation. So the key is, if we don't exactly need to know when it's going to happen, but if we know that it's going to happen at some time, a real incentive to be able to acquire your portfolio now before that happens, then interest rates go down, home prices go up, and you're able to accelerate your profits.
Yeah. Love that. Love that. I just got to say, Paul, that's a very healthy headspace. Control what you can control. I think it's an underrated piece of advice, and I like how you focus on that, because in such a noisy world and in all this stuff coming at us, I find that the people I most want to hang around with are the folks that think about that as opposed to all the other things that can distract you, right? So control what you can't control. We know that getting into rental income properties, the way that this thing is done, is going to build long-term wealth. It's a staying game, right? You stay in the game. People don't say wait to buy real estate. They say buy real estate and wait, right? So the idea is control what you can control. If you can, I think Paul talked about it as like stacking wins and these different things. I'm going to take it back to his baseball metaphor. If you can put guys on base, if you can focus on getting hits and putting runners on base, eventually they come home, right? And acquiring these rental income properties is exactly that. You're getting on base with this stuff. You're starting this long-term wealth building mechanism that will continue to work. When interest rates go down, guess what? Price goes up and you have that locked in and you get to refinance when the interest rates go down. That's fantastic, right? But the idea is get on base, start building that long-term wealth. Everybody that's been in this game for a long time gets looked at by everybody else like, oh man, I wish I would have done it, blah, 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 blah. But you guess what? You're not going to be that person unless you get it on board, right? So the way to do that, shoot an email to info@jwbcompanies.com, go to chatwithjwb.com, get that conversation started, right? This is not a short process. JWB is going to prepare you with the context of what you need and how you got to do it. It's going to take like 2 to 3 weeks. It's going to take multiple calls to make sure that you know what you're getting into. So the first step is that go set up that call, make sure that you know what you're getting into, and just get that knowledge, get that ball rolling, and get on base so that you can get home at some point.
I love it.
And last but not least, Paul, thank you, buddy.
Man.
We appreciate you
Yeah,
being
man.
here.
I
You
love
always
it.
bring awesome people, always great questions from the Fortune Builders community, our community that shows up week after week, where we've been, the other day, I think Tuesday, we had like 70 something. We're like, oh, 70 something. Because we've been used to like 100 people. 2 years ago, we would have crapped our pants if we had 70 people on the call. So like the community's growing. This is phenomenal. The fact that you all take an hour out of the middle of your day, an hour and 20 minutes out of the middle of your day to hang out here, make friends with folks, add to the conversation, ask great questions, right? Challenge us on this thing so we can explain it better and better is really what makes this show what it is. We do this for you. You make it great. Next Tuesday, we are getting into buy or sell. What part of the market cycle are we in? We're going to break down this idea of a real estate market cycle and how people kind of see it differently. Maybe cycle isn't the word, but where are we in that cycle? What is happening? Gregg's got some good data, some good things to come. So hope you join us on Tuesday. And until then, any piece of advice, gentlemen? Don't be average. Paul, see you later. Nice muscles.
See you, buddy.